Welcome into the closing bell wrap on Storm Stock Solutions. I'm Grant Mercer. A choppy session for the market today with a clear rotation under the surface. Energy and metals catching a strong bid, while parts of tech, especially software, got hit hard, widening an already big gap between the have and have-not stories in the growth complex. Let's start with a standout move: commodities. According to reporting from MarketWatch, global oil prices just settled at a 6-month high after surging nearly 5% on growing bets that a U.S. strike on Iran could be imminent. That's a geopolitical shock premium showing up very clearly in crude. Traders are focused on the risk of disruptions to the global flow of oil, especially through key choke points, and that has been a tailwind for energy stocks and related services names throughout the session. It wasn't just oil. Copper closed at a record high, and one analyst quoted by MarketWatch said metals are going absolutely bonkers right now. When you've got copper, gold, and other industrial metals all ripping at the same time, that usually tells you two things. Markets are repricing both geopolitical risk and some version of global demand or supply tightness. Materials and miners were clear areas of strength that professionals were leaning into as a hedge and as a momentum trade. On the flip side, big cracks showed up in software. Emily Berry at MarketWatch reports that software stocks just suffered their worst day in 10 months, even as hot chip names continue to attract flows. That widens the already sharp divide between semiconductors, which remain the market's AI darlings, and the broader software complex, where investors are increasingly demanding clean earnings, visible growth, and less multiple risk. This is one of those days where the index-level move doesn't fully capture what's happening under the hood. Money is rotating within tech, not necessarily into or out of tech as a whole. Another interesting tension point came from the consumer and payments side. Mastercard shares climbed after earnings, with at least one analyst saying the company got off to a strong start this year and defies fears of slowing consumer spend. That's the good news. The risk angle is that this kind of print raises the bar for the rest of the payments and retail ecosystem. Markets will be watching to see if other card networks and banks can echo that resilience, or if Mastercard is an outlier. Strong spending data can also reignite worries that the economy is running hot, which in turn can stir up questions about rates and inflation expectations, even on a day when macro headlines were relatively quiet. Beyond sector rotation, we had a couple of important corporate and governance stories that could build over time. Victor Reclitus notes that big names like Tyson Foods and Amazon are facing growing shareholder pressure to spell out how Trump administration immigration policies are affecting their operations. That puts ESG, labor, and political risk back into the conversation heading into proxy season. It's the type of story that doesn't move a stock 5% in a day, but it can shape how boards communicate, how companies think about workforce strategy, and where reputational risk premiums get assigned. In the background, Elon Musk's universe stayed in focus. William Gavin at MarketWatch highlights that Tesla could be sliding back toward a more aggressive cash burn mode as Musk pursues a costly AI vision, with capital expenditures expected to top $20 billion this year, more than double last year. For traders, that's a reminder that the Tesla narrative is increasingly tied to AI, autonomy, and data centers, not just cars. But with that comes higher spending, execution risk, and potentially more volatility around financing and margins. At the same time, separate reporting from Gavin points to SpaceX preparing for an IPO, with the potential for even tighter financial and strategic links across Musk's empire. That's a longer-term theme, but it's on the radar for anyone watching AI infrastructure, satellite connectivity, and high-profile growth listings. Before we look ahead, a quick word on a couple of Reels Economy articles that are worth keeping on your radar. There's a story about Yale offering free tuition for families earning under $200,000, which underscores how stretched the middle class feels even at six-figure income levels. And another piece profiles a 71-year-old with several million in retirement assets who still can't quite relax about cash flow. Those personal finance themes don't move today's tape, but they do color how households feel about wealth, spending, and risk. And in the longer run, that sentiment filters into markets. So, what do we watch for into tomorrow's session? First, whether the spike in oil and the record in copper see follow through or fade. If geopolitical headlines around Iran escalate further, energy and defense-related names could remain front and center, and volatility in broader risk assets could pick up. If things cool off, you may see some mean reversion in the commodity space. Second, that tech bifurcation. Software's worst day in nearly a year will have traders re-examining earnings expectations and valuations across cloud, cybersecurity, and enterprise names. while keeping a close eye on whether chip stocks can keep pulling in capital without a pause. Rotation within tech has been a recurring theme. Today's move just turned up the volume. Finally, on the consumer side, the Mastercard signal versus the macro worries. Strong card spending data will keep the debate alive about how durable the US consumer really is and whether markets have gotten too pessimistic or not pessimistic enough about a slowdown. That's a storyline we'll be unpacking again in tomorrow's pre-open show. I'm Grant Mercer, and this is Storm Stock Solutions. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer.